Hey, thanks for watching. We're coming to you from Fool Global Headquarters in Alexandria, Virginia. I'm Chris Hill, here with Bill Mann and Sean Gates. Thanks for being here, guys. One disclaimer. Yes, it's our first time with a disclaimer, but Sean Gates, certified financial planner, is from the Motley Fool's separate sister company. Didn't know we had sister companies, did you? We do. Motley Fool Wealth Management. Please note that Motley Fool Wealth Management's advisory services are only provided to their clients. The views expressed today are Sean's and do not necessarily reflect those of Motley Fool Wealth Management or its affiliates. These comments, including comments on securities, may not be relied upon as recommendations or investment advice. That's a little tip for you at home, kids. When the lawyers tell you to read the disclaimer,
do it.
You read the disclaimer. All right, let's talk about investing, which is something that we love to do, but a lot of people, so many people out there still are not investing, even with the rise of the bull market that we've seen. So we're going to talk today about an easy way to do investing, and that's through mutual funds. And let's just start, Sean, with the most basic of definitions. We don't want to assume everybody knows what a mutual fund is. What is a mutual fund?
Yeah, so a mutual fund is simply just a pooled investment vehicle. You can think of it sort of like a wrapper around the underlying investment components. Typically, you'll pay a fee for the individual stock selection that's inside of the mutual fund or whatever component parts are in there. You want to keep in mind that there are active and passive versions of mutual funds. Typically, you will need to be aware of the fact that you don't own the underlying shares of the mutual fund. You own an interest, pooled interest in the mutual fund. And so you can be liable for capital gains that other people might have experienced or things of that nature.
Yeah, so really simple way to put it is with one ticker, you get access to a number of different, dozens, even hundreds of different appropriate securities to that strategy.
Yeah.
Let's talk about the active versus passive, because I think in general at the Motley Fool, we are fans, for a number of reasons, of passive investment vehicles. The most famous, probably the one that's name-checked the most, the S&P 500 index fund.
It's a pretty good fund. And it has actually beaten about 80% of all of the active funds that are supposed to try and beat it every year. So, it's been said a bunch of different times. Burt Malkiel has said it. Warren Buffett has said it. If you don't think you know what you're doing, really the best way to get broad exposure is by getting the S&P 500 index fund, which is 500 of the largest U.S. companies.
Well, and what's great about index funds is there are a lot of different indices out there. I mean, we talk about the S&P 500. It's a great fund. I've got an S&P 500 index fund. Yeah. But Sean, there are a lot of other indices out there. You can go small cap. You can go international if you want.
Totally, yeah. I mean, there's the S&P 400, there's the EFI index, you can actually create your own index if you wanted to. So there's a whole number of
I don't recommend doing that at home, by the way.
Speaking of international, Bill, is that a good way for people who are starting out investing to maybe dip their toe in investing overseas? Because here in the United States, one of the things we benefit from is we've got a strong regulatory body that the public companies have to follow. That's not the case in every country out there. So it would seem like I'm interested in investing in Europe or Brazil, and maybe a mutual fund or an ETF is the way to do it.
Yeah, think about it this way. The U.S. is 5% of the world's population, but 54% of the world's market cap, when you add up all the stocks here versus overseas. When you are thinking about investing overseas, there really are a couple of impediments to being able to invest in many individual companies and getting exposure overseas. So mutual funds may actually be the easiest, cheapest way to do it.
In terms of investing in a fund, Sean, before we get into picking funds, and I know you guys have a couple suggestions for anyone who's maybe shopping for a mutual fund, what are sort of the nuts and bolts in terms of setting up an account and funding it?
Sure. I mean, so very similar to if you wanted to buy stocks, you would want to set up a brokerage account. It could be a retirement account. It can be a taxable account. But you would go to somewhere like Fidelity, Schwab, et cetera, and just say, I'd like to open a brokerage account. And then from within the brokerage account, you want to add funds to it, and then you would be able to electronically place transactions. And one of the things that you can invest in would be a mutual fund and their ticker.
Yeah, you can also buy the mutual funds directly from the fund company itself. You can open up an account with Vanguard, for example, and they have hundreds of funds that you can buy, including their S&P 500 fund, which is a very cheap. When you go through a broker, it allows you to keep everything together in one place as far as you're concerned. It is a slightly more expensive way to do it.
Yeah.
Well, and speaking of expensive, I think one of the things that may keep people away from mutual funds is the cost right out of the gate, because a lot of times, unlike stocks that have a price that moves every day, you want to invest in a mutual fund, a lot of times there's it's almost like poker. There's a minimum buy-in. You have to put up $2,000, $3,000 out of the gate. I know that was the case when I was starting out. Is that still the case today?
I would say, by and large, yes, there is still a minimum amount that you need to invest. Some of them have come down, and depending on the scale of the mutual fund,
Some are as low as $500, but it tends to be, I mean, if you think about it from the mutual funds perspective, which is not a perspective that we tend to, to think about,
or care about.
You are setting up you are setting up an account, and they do have some expenses that they're bearing on your behalf. So there are minimums for a reason.
Is that why ETFs are popular to the extent that they're popular? Because essentially you get to buy them in smaller chunks.
Yeah, that's definitely one reason.
Although I would say, so ETFs are typically intraday liquid, like stocks, whereas mutual funds are typically daily liquid. So you would only be able to liquidate the position at the end of the day.
Yeah.
When it comes to stocks, individual businesses, there are different metrics that we like to look at as investors. Let's get to some of the metrics for funds themselves. Bill, expense ratio. What am I calculating and what am I looking for here?
So there are a number of ways that you end up having to pay a mutual fund company for the right to have them manage your money. The basic one is the expense ratio, which is an amount that they subtract from your fund annually. So it is a cost that you don't just pay it when you show up. You pay it every single year that you that you are a customer of the fund company. And we generally like to say that the lower the expense ratio, the better.
Sean, when it comes to turnover, which is another thing we like to look at with mutual funds, is it safe to say, similar to what Bill just said, the lower the turnover, the better?
I would say by and large, yes, particularly for stock-focused mutual funds, because that's where the capital gains issue can arise. But if it's something like a bond portfolio, or at least has exposure to other underlying investments, turnover could be okay, but typically lower, better.
Yeah, so what Sean is saying for capital gains, even if you don't trade in and out of the fund, so with the stock, if you hold it for 15 years, you're never paying tax on the gains of the stock. But with mutual funds, tax law has it so that you have to pay based on the transaction that the fund manager makes each year. Those are taxable to you. So it is something that you need to be careful of when you're looking at funds. The higher the turnover, potentially the higher the tax bill that you're going to have to pay each year.
Let's get to fees, because that's been mentioned a couple of times here. I'm reminded of the guy who goes in to buy a car, and the guy at the car dealership says, "What would you like to pay for this car?" He said, "I'd like to pay nothing."
That's right.
So
thank you for asking.
When it comes to mutual fund fees, obviously we want to pay as low as possible. But what's reasonable when it comes to active funds, and what is a reasonable fee for a passive fund?
Passive funds, okay, so it makes a little bit of a difference what you're talking about. If you're talking about ones that are linked to the S&P 500, you can find ones that are charging 7 basis points, which means for every, let me see if I get the math right, for every $1,000 you're paying 70 cents a year?
I believe that's right.
Is that right?
Yep.
Yeah, so not very much. With more esoteric funds, or when you start going international or things like that, you're going to see higher expense ratios. And I don't necessarily agree with the orthodoxy that the Motley Fool has about expenses, in that if you have a fund that has shown a really excellent long-term return, you should be willing to pay up.
I would say a broad range that I tend to pay attention to when I'm helping clients would be on the order of 75 basis points. So if 1% is 100 basis points, 75 basis points.
Yeah,
something.
As a blend, right?
As a blend, yeah.
In terms of fund performance, we've all heard the line, past performance is no guarantee of future success. Isn't it though? Like, particularly when it comes to active funds, if we're talking about human beings who have a track record of 5-10 years, I guess my question is, to what extent should I, if I'm looking at mutual funds, to what extent should I be looking at past performance? Because I know that from a marketing standpoint, the marketing people are probably going to say, well, over the last 5 years, it's done this. How much weight should I, as an investor, give past performance?
I would say you want to give it a serious amount of weight, but you have to be careful because the disclaimer that we always have is past performance is not indicative of future performance. And so you could have a rock star manager who's been managing a fund for 10 years, and then when you put your dollars in his hands, the next year he does terribly. And so the track record is not indicative of what you can expect. But I do think that track record is an indicator of the procedure that the portfolio management team takes, their methodology, and that is important.
Especially as you go longer term, going backwards, and the longer you have going forward. If you were investing in, well, really in anything, but we're talking about mutual funds. If you're looking at something that's returned 15% per year over the last 10 years, that's a great result. And I would, I'd bite someone's hands off for those type of results. But that doesn't mean that this next year you're going to make 15%. And if if you've got 365 days, you really have to be realistic about what kind of returns you're going to get.
All right, we're going to get to your questions in just a moment. Some good questions coming in. We're going to get to the mutual funds that these guys have in terms of a watch list, to the extent that you're building a watch list for mutual funds. But first, I want to give a quick mention. I know we're talking about mutual funds, but typically we're talking about stocks. And if you're looking for some more stock ideas, Tom Gardner, CEO here at the Motley Fool, has put together his top stocks for 2020. It's in a report available to members of Motley Fool Stock Advisor, which is our flagship service. So if you're already a member of Stock Advisor, just go to fool.com/2020. You can check out the report. If you're not a member of Stock Advisor, you can still go to fool.com/2020 and you can get details on how to become a member. You'll get access to the report from Tom Gardner, his top stocks for 2020. Sean Gates, let me start with you. For people who are looking for ideas when it comes to mutual funds, what do you got?
So I tried to go dead simple. So my mutual fund is the ticker F as in Frank, B as in boy, ALX, L as in Larry. It's a low-cost fund, so we were talking about fees just a little while ago.
That says bulks, right?
Yeah.
Is that great?
That's why I picked it.
Okay.
The only reason why I picked it. So we were talking about fees, and the fees on it are quite low. The expense ratio is approximately 0.5, 0.53, something like that, or half of 1%. And it has a nice mixture of equity and conservative posture. And so if you don't have the largest risk tolerance in the world, or if you're meeting your equity needs in other areas, like with an S&P 500 index fund, this can be a moderate single ticker allocation that should give you very consistent rates of return. Its 10-year historical track record is actually 10%, which is more like a full equity model portfolio. And within the equity sleeve, it has a very concentrated mixture of individual stocks that's then balanced out by conservative things. So just a very simple, very easy, low cost, great way to get invested.
All right, Bill Mann, what do you got?
I did the opposite. So when I think about mutual funds, when I think about people investing in active funds, what you really want to be doing is investing in areas that maybe you don't think you can do yourself, or that you structurally cannot do yourself. I talked about international stocks earlier, and I actually have a recommendation there. But the fund that I'm talking about is a small cap, a microcap fund called the Wasatch Microcap Fund, and the ticker is WMICX. They have an unbelievable 20-year record, return of 13.2% per year over 20 years, which I think you'd say is actually indicative of how they of a really remarkable investing process. A little expensive is 1.6% in terms of an annual fee. So, and they have $600 million in assets. And to me, especially with small cap funds, the asset base is something really, really important to think about, because you want to make sure that you've got a fund where they don't have so much money that they're running out of ideas. And that really happens a lot in the small cap. So I actually don't understand why this fund is as small as it is.
Fantastic. We're going to get to your question in just a second, but first, if you're enjoying the video, please consider giving us a thumbs up. Give us a like. It helps other people find the videos that we do and helps us keep doing more of these. And again, fool.com/2020 if you want to get Tom Gardner's report, his top stocks for 2020. Let's get to some of the questions that are coming in. Jim asks, why do people use basis points instead of percentages? It's kind of confusing. 0.75% is 75 basis points. I got to say, I'm 100% with Jim on this one. Is this just like, this is how we've always done it in the mutual fund industry, and so we're just going to keep doing it?
Well, it may actually go back to, one of the things when we founded the Motley Fool is we wanted to get through some of the jargon, and I would say that maybe basis points is something that's held on. There actually is a pretty good, reason. So you've got something that's at $10 and it goes up 0.75%. That's different than going up 75 basis points. So because you're dealing in increments of one, they use it's actually a math term, but I kind of agree, but I've also kind of signed on to calling them basis points.
Yeah, and for me, when I'm speaking with clients, I usually try to just do both, because some people know it as basis points, some people know it as percentages, and it can get very awkward to say 0.35%. Because then they might be like, was that 35%? So you just have to be careful.
I think maybe we should pledge to stop using basis points right now.
I'm down.
Yeah, Jim, you've convinced us.
Question from Ryan, who asks, for beginners, are mutual funds better than buying starter stocks? Great question. I'm not picking one way or the other. I will simply say, in my own investing life, my first investment was an S&P 500 index fund.
I think it probably depends on your age as much as anything else. If you are a 20-year-old and you're interested in getting out there and and learning about the stock market and learning about stocks, go buy a stock, right? Like, you don't really need to be diversified as a 20-year-old because most of your earnings are ahead of you, right? But if you're a little bit older and you're just starting to invest, and even whether you want to learn or not, I would get diverse as quickly as I could. So, I mean, that's I don't know your exact situation, but that's how I would think about it.
And I think the only thing that I would add is, so risk tolerance is a critical thing. So if you are a more conservative investor, a mutual fund is going to give you a way to get exposure to a wide range of stocks so that you aren't exposed to company-specific risk. So that's very important. And then the other thing is, just from a kind of a behavioral perspective, buying an individual stock can get you bought into the story and more willing to hold on to that stock. And that's really critical. Whereas if you own a random mutual fund that you don't have any association with, you might want to sell it at the first sign of trouble. And so that's the only other thing I'd mention.
I thought that the financial planner was about just to stab me when I started saying, no, don't worry about being diversified.
Speaking of holding on to stocks, one person asking, you guys tend to say you should buy stocks and plan to hold them for 5, 10, 15 years. Is that the same guidance for putting money in mutual funds?
I think even more so. I think actually even more so. If you're making the decision, because if you think about mutual funds, these are asset allocation strategies, right? So you are literally saying, I'm going to have X% of my portfolio in this type of vehicle, which is a mutual fund, and then and so on. And yeah, so it is even more so. These are things that you just don't need to be cute with and sell in and out of.
Yeah, I'm in full agreement. I think any investment dollars that are at risk of temporary loss, just from a human behavior perspective, should try to be focused as long a term as possible.
Yeah. Now, one thing that people do with mutual funds, or they do with financial planners, is that they'll make adjustments year in and year out. They'll say, I want to be 10% in emerging markets, 25% in large caps, and so at the end of a period, they'll readjust so that they're back to those percentages, and that's a different story, but as opposed to buying and selling the entire instrument.
One viewer asked, what do you think of target date funds? I've read that some people think target date funds are too conservative.
This is a really good question, probably in the weeds. So my personal opinion is target date funds can be very conservative, and the reason for that is that this is being calculated usually around age, right? So it's saying, okay, you are 20 to 25 years away from retirement. That's backing into your age, and so therefore you need a certain amount in bond to protect your, or conservative assets to protect the income that you might need to turn on down the line. where in reality they have no way of knowing how much income you need to support from yourself off of your portfolio. So you might be a 70-year-old investor and have a huge pension or a giant real estate empire, and you don't need any income from your portfolio, so you could be 100%
Beanie Babies, something, right?
Beanie
Yeah.
Babies,
Whatever.
So you could be 100% in stock, and then a target date fund is going to really steer you wrong because most of them are not 100% stock.
Paul asks, I'm big on investing in individual stocks, but I would like more exposure to certain countries like India. Is there a way to get exposure to a single country with mutual funds?
Yeah, there are India target funds. There are also ETFs that are single country, and India is not even a particularly weird one. You can get a Nigeria focused ETF. The thing I would say about buying the individual ETFs for smaller countries is that they tend to be very heavily weighted towards the banks and then whatever the big industry is for that country. So in India, for example, it'd be textiles, it'd be banks, it'll be, so you're not necessarily getting great exposure to the growthiest parts of these markets. So I actually had a second fund recommendation that this might be a good place, to put in, which was the Driehaus Emerging Markets Fund. The ticker is DREGX. So it's a growth fund. So they go, to countries like India, countries like China, anything that's in the MSCI Growth Index, and they spread their bets across there in the more promising industries. So yes, you can get exposure to India through single funds. I would be really careful about what's in those funds because you don't necessarily want to be invested in a bunch of Indian banks.
A couple of people asking about the basic difference between mutual funds and ETFs, and we may have glossed over that earlier in this.
We totally glossed over it. Let me know maybe about it.
So for someone who asks you, what is the difference between a mutual fund and an ETF?
The basic difference is that an ETF trades like a stock. You can buy and sell it all day long, which is good or bad, right? But ETFs are meant to be traded on the exchanges when the exchanges are open, whereas mutual funds are not meant to be trading vehicles. They tend to have actually much lower turnover for the instrument itself, and they are only cast at the end of the day.
Jerry asks, actually, we'll get to that in a second. Ashley asks, I'm very new to investing.
Sorry, Jerry.
We'll get to you, Jerry. Hang in there. I'm very new to investing. Literally started 2 weeks ago, and I found your website very helpful. Thank you very much. We actually, the three of us, designed the website.
And wrote it.
The question is, with the coronavirus and concerns over a global emergency, are you worried about that negatively affecting stocks and funds? It's a great question, and particularly with earnings season going on right now, we've already seen big name companies like Apple, Starbucks, McDonald's talk about the effect of the coronavirus on their business in China.
Yeah, worried? Nope, but it'll happen. I mean, it's going to happen. Every single country that has any exposure to China is going to have to talk about it. So today they announced that they're reducing, European airlines are no longer flying to China. Russia has closed its border with China. So yeah, it's going to be absolutely an impediment to global trade. But, over the long term, think about the effect now of what the SARS virus was. It's, over the long term, it's not going to be, a very big deal.
And I would say this is actually a pretty important question, especially as you're getting started. And again, thank you and congrats on getting started. It's important. But if you look back at past pandemics, especially the SARS virus, the stock market actually just went straight up during the SARS virus. And so you can't necessarily use these types of things as an indicator for how you should be investing. If you're just getting started and you're relatively young, you want to be thinking in multi-year periods of time. It's seductive to want to think that you can say, there's this pandemic coming, I should be out of the way so that I avoid that temporary dip. You want to start building the characteristic of holding through whatever dip may come from the moment.
Or actually even buying during fear.
Yeah,
right?
Totally.
All right, let's get to Jerry's question. Jerry asked, does the Motley Fool have their own mutual funds that they manage? The answer is yes, which leads me to my second disclaimer about Motley Fool Asset Management, which is where the funds are sold.
It's another sister.
It's another sister company. This is not the offer for sale of any security or funds. Motley Fool Asset Management is a separate sister company of the Motley Fool LLC, and it manages mutual funds, as well as the Motley Fool 100 ETF based on conviction ratings from the Motley Fool's analysts. All investing, including ETF investing, involves risk and possible loss of principal. For viewers who are not shareholders of the funds, you should consider the fund's investment objectives, risks, and expenses carefully before investing. Prospectus of this and other information, and all the information on the holdings available at the MFAM Funds website. Please read the prospectus carefully before investing, as you always should.
Yep.
And I'm pretty sure we're going to put all of the stuff that I just said down in the description below. So there you go.
Is it weird that I found myself like looking down in guilt as you read this?
Is that normally your...
It does sound like a lawyer statement. My client is...
More questions from the audience. Chelsea asks, can I buy American funds from Kenya?
Oh, that's such a great question. The answer is, yeah, I mean, you have access through your local brokers in countries around the world to a wide array of funds. Now, usually the fund companies, I can actually speak directly to this because of my knowledge of of Motley Fool Asset Management, was that we were only supposed to sell to people who had addresses in the United States of America. Yeah. There's a lot of reasons that you might have an address that is available to you in the United States. So if you have access to a US bank account, you are able to buy US funds.
Mm-hmm. Great question from Chuck, who asked, would you suggest someone use a Roth or traditional IRA if they are starting out with mutual funds or ETFs?
So I think it's less about whether you're starting off with mutual funds or ETFs and more about what type of growth profile you're looking for. And what I mean by that is a Roth has a very specific tax advantageous nature in that any growth inside of the account you achieve tax-free. And when you take it out, you don't have to pay income tax on that growth or the principal contributions. With a traditional IRA, you're saving pre-tax, meaning you get a little bit of a tax deduction as those dollars go in, and then it grows tax-free. But when you take it out, you have to pay income tax on it. And so just depending on what your situation is and what profile you're looking for from tax advantageous structure, that would be one good way to think about it.
Oh, I have something else to say to Chelsea from Kenya.
Okay.
If you go to a Kenyan brokerage, they will have mutual funds that are based in Kenya that have exposure to U.S. stocks. So you can do it that way too.
Great. One person asking a question about benchmarks, and we talk about this all the time, particularly when we're talking about stocks, and we like to compare our returns with our stock portfolio to that of the S&P 500. One viewer asking, when looking at mutual funds, does the benchmark change depending on the fund?
Absolutely, and it should, because if you've got a fund that is all micro caps, they're not necessarily trying to beat the S&P 500, right? They're trying to beat a relevant microcap. Or if you've got a fund, as we were asked about India earlier, like the Indian Stock Exchange will perform vastly differently than the S&P 500 will. So it's impossible to know whether the fund company has done good or bad based on the S&P 500. So it matters a lot. The one thing that I would say as a red flag for mutual funds and mutual fund companies is if they change their benchmark a lot, which is in their prospectus, it may be that they're like trying to move their targets. So the key is if they pick a benchmark and stick with it.
Yeah, and I think I would add that I'm a little bit nervous lately because everyone is starting to benchmark everything against the S&P 500, and things are different. So if you're in an international mutual fund, it can't be true that your benchmark is the S&P 500,
right, yeah.
Even though many people are defaulting to that. And so you just have to be careful. There's a lot of concentration in the S&P 500. Even if you took something that we haven't mentioned, but a very attractive passive index fund, the Vanguard Total Market Fund. Right, that's a great fund, and it has diversification inside of it, large cap, medium-sized companies, small cap, et cetera. If you compared it against the S&P 500, it's done worse over the last few years because the S&P 500 has done so well. It's crazy. And so you just have to be careful of what you're choosing your benchmark against.
Yeah. One viewer asking, is there really a big difference between an expense ratio of 0.75% and 1.25%? I mean, 0.5%, what does that mean over the long term?
Over the long term, we always think of returns as being temporary. I mean, a return can reverse itself. An expense is for real, right? It's getting taken out whether the fund has done really well or whether it has done poorly. As a rule of thumb, you want those expenses to be as low as possible, because even a 1% difference, that doesn't sound like very much. If you take that compounded over time, it's a pretty substantial difference.
Yeah. I mean, compounding is the key there. Even 0.5% compounded over many years can add up to, depending on the portfolio size, several tens of thousands of dollars, even hundreds of thousands of dollars in cost
of
value.
Yeah. Which is to say, again, I am not afraid of funds that have higher expense ratios, but it's got to be worth it.
Yep.
Yeah.
You are afraid of spiders, though.
Deathly.
All right, Bill Mann, Sean Gates, thanks for being here. Thank you so much for watching. Thanks for giving us a thumbs up to help spread the word about the video. We appreciate it. And again, fool.com/2020 if you're looking for Tom Gardner's top stocks for 2020. Check that out when you get a chance. I'm Chris Hill. Thanks again for watching, and we'll see you next time.
I know a cheapskate always has a headache trying to get something for free. None more wiser is the miser, always lives in misery. I own a bank